Welcome to This Week in Money. I'm Jim Goddard. Today, Chartworks CEO Ross Clark will take a look at the momentum on the major markets. He says a chance for the precious metals to rally fell flat. Market historian Bob Hoye examines how the markets continue to rise, even though so many have said the growth is unsustainable. He tells us what he believes will be the warning signs that bubble is ready to burst. Editor of Rick's Picks, Rick Ackerman, talks about the death of the shopping mall and what might take up that space. He believes urban planners know little about the organics that make a healthy, growing community. Plus, at the end of the show, we'll feature company showcase updates from American Manganese CEO Larry Reaugh and Glance Pay President Penny Green. We'll talk to Ross Clark right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Reaugh Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's the CEO of Chartworks. Welcome to the show, Ross.
It's a pleasure to be with you, Jim.
The equity markets in Canada and the U.S., record highs earlier in the week. Have we seen any adjustment from that?
Oh, you've got a few pauses, but then back up to new highs at the tail end. Pretty dramatic action, when you take a look at this number of months. So, here we've just gone through, theoretically, what should be the weak period of the year. So that being May through October. And when I look back, say it's been post-Second World War, you've got maybe 25 years like this where the market continued to have not only just an upside bias through that period, but actually was up 5% or more. And of those 25 years, 22 of them went on quite nicely to rally right into April. There's some choppiness along the way, but good action through December, maybe a small correction in January, February, and then buoyancy once again into April. So as we're into this stretch of November through April, I think that as we've sort of had all along here, the idea of being a buyer on decent corrections for now. The corrections we thought would be in the 5 to 7% bracket as we went through the summer, but they were limited to 3% on most of the indices. And there were some stocks that got hit, but in general, the indices have been walking up, and there's been good rotation. The financials took over from the FANGs for a while, and at this point, you've got technology stocks back leading the way. Here we were a week ago. You had Microsoft and Amazon. Now you've got Apple out here with their numbers, and everybody's doing pretty well. Decent momentum moves on the upside. A few excesses, but nothing to be worrisome as of yet.
We keep being told that so many stocks are overvalued, yet people keep buying them.
Well, but volumes are not that dramatic on in terms of the participation by the public. Clearly, when you look at the ratio of bulls to bears and the difference is not only just the ratio, but the difference between the number of bulls and bears, you're starting to see extremes there. But in terms of the money that's actually coming into the market, we're not seeing that euphoria yet. And typically, in the modeling that I look at, you would get that euphoric move like we had at the end of 1999 or into 2007. You get that big upside action. You get then what I would classify as some exhaustion moves where you get a buying climax. You get an automatic reaction back. You get a correction back. And then you go up to make a final high with diminished momentum on the upside, and you start to get a rolling top. And for individual stocks or commodities, spike highs are not unusual, but for broad indices, they tend to be more of a rolling process at the top. So if we can spike up a little bit here as we move towards the tail end of the year, get a correction after that, and, a minor style correction and new highs again. It's that secondary new high after you've had your first break that you really need to look at closely. So for all that valuations might be at an extreme, valuations can get stretched for many, many months. So I tend to look at the money flows, the volumes, and I don't see the excesses yet to be of a major concern.
Ross, precious metals looked like they were going to break out, but did they?
They had it was a week and a half ago. We had some really good short-term oversold readings in the silver market, in the gold market. You had the U.S. dollar get up into a minor overbought. And we had this type of signal that you see typically if you're going to have a small correction, 2 to 5 days, you'll get one of these, and if it's a good market, it will then have a pause and get legs on the upside after that. In the case of these markets right now, precious metals definitely failed on this rally attempt, and they are right on some very important support lines going back to last December. The mining stocks look as though they're having pressures, so I think we're going to be looking at the classic in December, January before we've got a good turnaround in that complex.
Ross, you're no longer at CIBC Wood Gundy. Can you tell us about the change?
Yeah, I put in my years there, and my partner has taken over my part of the business, and I'm now moving on to what really has been my passion, which is that of doing research. From day one, whenever I saw somebody with an estimate on price activity or calculations in terms of the technicals, I would go back, find the data myself, and back test it to verify whether it was really up to what I would consider to be reasonable caliber. And over the years, when I've seen research, I've always tried to just verify it myself. I wanted to be independent, and so I didn't always toe the company line. I was doing what I thought was the best, and so I developed a number of indicators, and I won't call them systems, but various alerts in different styles of market movement. So when you have a market that's into a methodical mode like we've got on the upside right now, I have a springboard system which buys minor oversolds, looks for the small type of pullbacks that can be worthwhile. The NASDAQ in September was a good example of that, just a buy on the triple Qs there. Then as you get into a harder correction where you've got something like a Shopify, which had a dramatic move up this year, and then there was a short sale attack against it. In the middle of October, we got what I call a cap 2. So this is capitulation, but within a dominant uptrend, but a really, really hard oversold. Those type of signals generally give you a quick 10% price appreciation, maybe correcting 40% of the loss. And they're great for short-term traders who want to be nimble. Then we get the upside exhaustions I've talked about over the years. Those come in two forms. The latter one is like you saw when we were looking at the top in Bitcoin back in August. The first time it got up to 5,000 and then corrected down to 3,000. Those signals are really good at finding that really speculative blow-off. But that same type of signal also comes into play when you've had a long consolidation phase, and then that first breakout out of the consolidation. You will see good upside momentum, big volume coming in, you'll get way overbought, and you look at that then not as a sign of being overbought, but as a sign of strength. And so you want that first sign of strength that you have, you sit back and you wait for a correction that just comes back, maybe corrects 20 to 25% of the move, gives a nice oversold on the dailies, and then you get on for the really big runs. Those are the type of things that we saw in the Nikkei coming out of the bottom in 2013, and actually in January of this year it was Bitcoin it had broken out over 1,000. Nice overbought signal, came back under 800 in January, and that was a buy on a pullback there. So we've got styles that we will look at various points in market development. And as we move through the next month or two, I'm looking to gear up the type of material that we will present through the charting systems that I've got. And I welcome all listeners to send an email off to me at chartworks@gmail.com. And as the various packages are going to be put together, we'll let you know what they are. Hope to have something for everybody from the shorter-term trader to the long-term investor.
Ross, thank you so much for chatting with us.
And it's good to be with you, Jim. Hope to be back next week.
My guest has been Ross Clark, CEO of ChartWorks. His email, chartworks@gmail.com. Coming up, Bob Hoye, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Ackerman Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Ackerman's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at ackermanresources.com.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to This Week in Money, Bob.
Jim, it's good to be with you this week in money.
The extension of the bull market, does it look like it's going to slow down right now?
Well, you can always get those kind of swings, but this move is becoming impressive. Impressive because, one, it continues, but it is at valuations that are extraordinarily high. The one we like is where you compare the S&P to the Bureau of Labor's calculation of the average wage. And so it gives you how many hours need to be worked to buy a unit of S&P. And it is even higher than it was in 2000, which was an extraordinary bubble. That was back in the dot-com. And then you've got other valuations and momentum stuff and sentiment figures that are very high, seen only at or near cyclical peaks in the stock market. But for this one, this move recently, in August, the NASDAQ index had declined, and it declined enough to prompt what we call a springboard buy, which is a technical tool that we use in steady to rising long trends, and it gave a buy. So it's sort of like your buy the dip model. And now we're getting new highs on the NASDAQ and the S&P and the Dow, and the action is very strong. It's backed up by some pretty good stuff as well. They're getting better GDP numbers in the States and Canada, and of course earnings they can be contrived to be most anything. But you've got supportive stuff here now. In a good bull move, you will have the yield curve, which is the difference between longer-term debt and short-term, treasuries or government of Canada's. And that is in a trend called flattening, which you typically get with a boom, an economic boom, and the bull market for stocks. The other one that you typically get with these conditions is the credit spreads, which is the difference between high-grade and low-grade bonds. Because of confidence, I mean, people are not seeing any problems out there at all, then people will buy the lower-grade stuff on the assumption that it won't hurt them. So then that narrows credit spreads. But there's a little, I'd say since about August, the strong narrowing of credit spreads ended, and it's a dull trend. It's not supportive, and it's not a negative yet, but we're watching it closely. Those would be the two items that would suggest that would prompt our concern about the duration of this strong stock market. Now, out of the past, there are some examples whereby very strong speculative action ended close to year-end. One was the gold and silver mania of 1980. That peaked on January 20th or 21st. And then going back in the stock market, the 1973 stock boom was very robust, and it peaked on January the 11th. And that was followed, by the way, by the worst bear market since the 1930s. And then the other example of a turn-of-the-year conclusion was the Japanese market with the Nikkei making its spectacular high on the last day, trading day of the year in 1989, and then you had a lengthy bull market there. So this is not to say that the current wave of speculation can run that far, but we're using it as a guide that at the moment we don't see anything that would be like a brick wall to this move. But at least we have an idea of the items that would anticipate this bull move running out of power and perhaps rolling over. So, as what I said, that comes from experience and having the right technical tools. And yeah, we're content to let this run for a while yet.
Is it true that transports are usually one of the warning signs that a market is about to roll over?
Yeah, they can lead. That's the old Dow theory, which I think was one of your first technical tools, whereby if you have a bull market for the Dow Industrials and the transports keep making new highs as well, then that confirms the bull market. But then when the transports, and it used to be the rails, roll over and start underperforming, then that becomes a telltale on the market. That last we saw it and used it was in 2015 when, there was about 5 months whereby the transports were not confirming the bull move in the Dow, and then it all rolled over and you went into a fair sell-off, right? And that was when crude oil crashed from 105 down to $27, I think it was, in February of 2016. And then you've had the powerful move out of that. So from time to time, the transports can be a telltale on the direction of the market. So at the moment, nothing concerning there, but we'd be watching that one closely as well. And the other thing that floats around out there is, I saw a study on this a couple of weeks ago, an interview with some of the biggest money managers in the world. I mean, one guy was running $1 trillion. And of these top 6 big money managers, the view was universal that the only way something could go wrong is that the policymakers, the people at the Federal Reserve, for example, at the central bank, make a policy error. I mean, this is so naive. As I said, you get the telltale change in the yield curve and credit spreads. Oh yeah, also, industrial commodities kind of running out of steam too. They've been good. Lumber is just absolutely flying. I guess it's looking forward to selling a lot of 2x4s into house construction where there was much damage done to houses in the storms in August. So they've been flying, lumber and lumber stocks. lumber at the moment is probably short-term overbought, and it likes to do double or triple tops when it is making a huge cyclical top. So at the moment it's short-term overbought and could correct for a while, but it'll take a couple of thrusts before it rolls over. Now the other one that's interesting here, Jim, is we've been fascinated by the electric car phenomenon, whereby this has been a decision by governments to force people to drive electric cars. The first step was a hybrid car with battery-driven and with a internal combustion engine to make the whole thing go. And of course, the purist really likes just a straight battery car. So these have been subsidized, and I've often wondered just when or how market forces would have brought forward a pure electric car or a hybrid car without the intervention by the state with these things. The subsidies and whatnot are very compelling, in maybe $7,000 or $8,000 per car. And that was what hit Tesla stock yesterday, was that within the Republican tax package there's discussion of reducing or eliminating these subsidies for electric cars. And at the end of it all, Jim, the market is the best decision maker on this stuff, rather than, one very ambitious bureaucrat in government gets an idea that electric cars are a very pure form of transportation, and then he shares it with his colleagues, and then the media get going on it, and then eventually after decades it then becomes government policy, and it may not be wise policy, but the best way to determine whether it's wise policy or not is to let market forces do the adjudication. So we're looking forward to some changes there. The irony of it, Jim, is that with the electric cars, like Tesla is, I think government have risked something like $5 billion of taxpayers' money in this game of producing very expensive cars that really only wealthy liberals are buying. And then not only subsidized through loans and who knows what kinds of tax breaks, but to the company, but also you've had the subsidy to the rich people who buy these cars. So, in a free market world, you would not have these kind of distortions. So, if the Republican step to reduce tax breaks for buying electric cars does get through, then you'll have an honest adjudication on whether the market really wants electric cars or not. So it'll be fascinating to watch.
The Trump planned tax breaks, how will that affect Canadian business?
Well, it'll make the U.S. a little more competitive. And that is what the game is all about. You want as much competition within a country as you can for each type of industry or commerce. And of course you want competition between producers in different countries, because it just makes everything a little sharper, and it makes the costs of new items cheaper. And it's been a market economy has brought us this far to a longevity that is without precedent, and a general health condition that is also without precedent, and it has been mainly due to free markets developing products that people want to buy. So let's hear it for free markets, and let's see that there is less and less intrusion. And this is really what's going on with around the world. I've called it a popular uprising, whereby people get tired of in-your-face and in-your-wallet government. They're intrusive, and yet they take their money when they're forcing you to do what they want you to do. So there's a reaction to this, and in the U.S. I've called it the American Spring. In England it's Brexit, and in Europe you've got Austria as an election won recently by a young guy who is, on the reform side, and then recently something happened in the Czech Republic, similar on the reform side, and the people in Spain, in Catalonia, are trying to get away from the embrace of an authoritarian government. So the last time this happened was in the early 1600s, when bureaucrats had been out of control for more than 100 years and had corrupted virtually every institution that existed. And the historians have called it the Protestant Reformation. But that was, the focus was then on the religious struggles, when really the struggle was between individuals and authoritarian bureaucracies. So a better term would be a Great Reformation. And this, of course, is, I think, what's going on now, is another Great Reformation. And I would say so far it's been successful. Now, to get back to your question about if U.S. tax rates get more competitive, it will force Canada. And these guys have gone liberal wonky with some sort of strange thing. You know, a small business in the States employ about 70% of the workforce, and the same in Canada, about 70% of the workforce. And the policy wonks in Ottawa here are bent to screw it up as best they can. There's been a pretty good opposition to that. So there's some talk of them backing off a bit, but I think that Canada will be facing a popular uprising, and the more stupid the federal Liberals become, the sooner the popular uprising will be seen. And so I'd welcome it. It. For a political historian, these are very exciting times when a voluntary movement against intrusive government just bubbles up everywhere, at least in the Western world, and it's exciting to see, and it will be exciting to follow it.
We'll have more with Bob Hoye next on This Week in Money.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with market historian Bob Hoye, the chief investment strategist for institutionaladvisors.com. Bob, where are people putting their investment money right now, considering that everybody keeps saying that the stock market is in a bubble situation?
Oh, it's going into the stock markets either directly as investors. There's been a huge switchover from mutual funds to ETFs on individual stocks or sectors, but it's been flowing in that way. And then, of course, it's been flowing in through pension funds and other fund managers. And what is astonishing to me, even central bankers. Traditionally, the central bank reserve was held in gold, and then it left that some time ago, decades ago, and they applied modern portfolio theory to the concept of a reserve, and then you had to get a return, like an investment return out of the central bank reserve, and so then they were buying U.S. Shorter term stuff, say shorter than 2 years, Treasury bills. And then that became dull. So then a number of important central banks have been buying equities in their reserve account, and that is extremely dangerous. And we should recall the excitement in 1998 when the long-term capital management fund was underway, and it was headed up by people who had done serious scholarly work in pricing of options and things like that. So they became the darlings of the central bankers. Now, the central bankers were lending money directly to this highly leveraged fund. It was eventually just called by its letters LTCM. And even the Bank of Italy, who went absolutely crazy, not only lent them money for their speculative positions, but took an equity position in the fund. So then it went bad in the summer of 1998 because it was playing narrowing credit spreads, and that June spreads started to widen, and they widened such that then LTCM was forced to I think they were worth $4.5 billion, and bang, by October it was all gone. So, but because the central bankers had loaned money directly to the speculative fund, and as I said, in the case of Italy, they took an equity position, well, there was really a horrendous it added to the panic to somehow get the central bankers on side. So here we have now, with a number of the senior central banks, long equities in their reserve account, and one of them that's noteworthy is the Swiss National Bank, which has a lot of equities in there. Of course, when you're talking about equities, they would be going to the most liquid ones, which means the New York market and the biggest stocks. So, and then recently, you've got even the Dow Jones index of 30 stocks has been moving in a speculative fashion, and then the S&P caught up to it, and then now you've got a good strong move going in the NASDAQ. So this is, Jim, the most fascinating time to be taking a good look at the financial markets and what may happen over the next few years as an intense speculation finds that it's driven itself beyond fundamental support, and any intense speculation has always been followed by forced liquidation. So it'll be a double irony because the central bankers are leveraged up in equities, and you then have at the brokerage firms and at the banks, let's just say brokerage firms, you've got the margin clerk. And his job description is to get the accounts in line. So when the account is margined and leveraged up, and the price of the assets there starts to go down, then you get the margin calls and the sellouts. So, but you've never ever had the central bankers long so heavily in the stock market before. So I'm not going to say that the margin clerks will be putting out margin calls on the central bankers, but it is very amusing to think about it, and it may be less direct. They may just, force themselves out. So I'm glad that one can watch this. Who knows whether it takes 6 months or 9 months to happen, but the pricing of the bubble is now at unsupportable levels. The momentum is such that it's going to continue to run, and it's as simple as this, Jim. It runs until it stops, and that stop will be due to market forces, and it won't be due to the central bankers making a policy blunder. There's no way that they're going to do a blunder when they're long equities. So it's fascinating.
So where will this break come from?
Maybe industrial commodities such as copper or lumber or crude oil becoming weak. And then the other one that is very regular at the end of any bull market is that the yield curve reverses from flattening to steepening, and then the credit spreads take a turn to widening. I think the credit markets with the curve and spreads is more sophisticated than the stock market is. So these changes in the credit markets have preceded major tops in big bull markets throughout, well, as long as you want to go back. I mean, we have the U.S. Yield curve all the way back continuous to 1857. And, yeah, when the yield curve changes, the stock market follows. So, but at the moment, we could say as far as the financial speculation is stretched, which it is, the credit markets are still supportive.
If interest rates go up a few more times, would that be enough to convince people maybe they should invest or put their money into traditional banks and so on? Would they make enough money to make up for what's going on in the stock market, and would that cause the stock market to fall?
Yeah, that's appropriate, but it doesn't come down to a decision that's like that. I mean, people are going to be in the game that's making them the most money, which is price appreciation. And to go down to 2% in shorter term treasuries or government of Canada's, that's not a voluntary choice. Actually, if for those who do it, it's a very disciplined choice, is to say, okay, I've done very well out of price appreciation. I'm going to take some of it off the table and put it aside. And because there was a line a month ago about just how expensive it was to fund managers to be careful and to be out of the market, because you got this price advance going on. So it's always fascinating. So at least we have an idea of the items to watch that would give a warning on the end of the mania. And it is a mania, Jim. You can use any term you want. Irrational exuberance, mania, buying frenzy. What more do you want? I mean, it is all of these things. But it will continue. And as I say, this isn't a cheat or an out. It'll continue until it stops. And that has been the case on every great stock bubble since the first one that was focused in London, England in 1720. It was the South Sea bubble. And at the same time in Paris there was the Mississippi Company, and that was bubbled. And they reached excesses, and in both cases, in London and in Paris, the key financial people did everything they could do to keep the mania going, because the government was making so much money out of it. You know, you had taxes coming in, and in the case of England with the South Sea Company, there was a scheme there whereby they were using part of the money to pay down government debt. So that was a good thing too. So while they're on, financial manias have a great appearance of prosperity, but because everybody gets leveraged up on them, the prosperity disappears very quickly, leaving the problem of the debt, and that's the leverage side. And there's nothing anybody can do, even policymakers, if they have enough experience to become concerned about the speculation. There really is nothing that they can do to end the speculation. And you asked about that the rising interest rates may then change investor interest through other alternatives. No, what happens is that with the boom, short-dated interest rates, such as treasury bills, go up. And then when the boom is over, or just before the boom is over, then those short-dated T-bill rates go down. Well, at the moment, the U.S. T-bill rate has resumed its increase, and it's up to 1.18%. That's not a high number, but that's what it got to back in June, and then it backed off, and then now it's at the 1.18 again. So the now that's a market rate of interest. Now, too much of the time is spent focusing on what the central bank is going to do to interest rates, and that's called the administered rate. And I've found that through all the business cycles and stock market cycles, the senior central bank has followed at a market top the change in market rates of interest. So when the treasury bill rate starts its next decline, that would also be a warning on speculation. So it's not rising short rates that choke off a boom. It's that the market just changes and the bill rate starts to go down. So, and this is shows another foolishness in habitual thinking, is that if you go back to 2007, and in that September when you were getting the changes in the credit markets, which made people nervous, so then the statements by big spokesmen in Wall Street were that the Fed would lower interest rates and all would be well, they could keep the party going. And yet you've got 300 years of history before that showing that market rates of interest go up in a boom and down in the contraction. And the most rapid decline in short-term rates have only occurred during the nasty crashes that follow a great bubble. So the idea that the senior central bankers can save this from the usual contraction that follows a bubble, there's no empirical evidence, because the statement is that lowering interest rates will keep the party going. Empirical evidence shows that interest rates go up with the boom and down with the bust. So I think there'll be another, the market forces will provide another lesson sometime perhaps next year.
Bob, thank you so much for being on This Week in Money.
Jim, always good, and look forward to the next time.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Coming up, the editor of Rick's Picks, Rick Ackerman, on This Week in Money.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. I'm speaking with Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Welcome back to the show, Rick.
Always a delight, Jim.
The retail business in Canada and the U.S. in trouble. Sears, of course, declaring bankruptcy in Canada and leaving their employees dangling with no pension plan, no severance. Is this a trend that will continue to see across North America? Big malls losing their anchor tenants like Sears and being forced to turn to other alternatives?
Well, it's certainly happening a lot more quickly. I think it is inevitable. And, but it's, when you look at Sears has been the longest goodbye in corporate history. I remember trying to exchange a lawnmower in a San Francisco Sears, and it was so difficult. The process was so fraught that I thought this Sears is going down. But it's taken so long. It's a bankruptcy that's dragged on forever, or an incipient bankruptcy. And I'm down in South Florida now, where the malls are dying. This is going to be the last one to die because the consumer ethic is very, very strong down here. And there's a Sears in the town center in Boca, and it surprised me. I was thinking, geez, does Sears even exist anymore? But they do, and they have a fairly large presence in Boca. But this particular year, the suppliers are all tightening the screws, and what that means is that Sears, even to carry some of the Christmas toys that are supposedly going to be hot, they are on a cash basis. The vendors won't even ship to Sears unless Sears is paid up front with hard dollars. So, Sears can't survive that for too much longer. And as far as replacing the big, what few Sears big boxes, or parts of malls, there's a question like, what big box do you put in its place? Because they've all died too. And, what I've seen in Colorado in the mall near where I live is that they found kind of second tier, not big boxes, but semi-big boxes. And they're getting harder and harder to find because even the semis are kind of fly-by-night retailers you never heard of before that are kind of there for a year or two with some fad and then they disappear. So the outlook is not really good for malls, but we can see what's happening. They're just getting kind of asphalted over and turned into multi-use housing and offices.
Well, we've seen that in the greater Vancouver area, the Brentwood Mall, after the death of Zellers and then Target in the same space. It's now being turned into condos and offices. The plan in Burnaby, the third biggest city in British Columbia, is to change the Metrotown Mall, the biggest in the province, to downtown Burnaby, where they'll have actual streets and businesses at street level and condo towers above that.
Well, we can only hope that those conversions take place in a way that gives us good organic little town centers. In Boulder, near where I live, they missed the opportunity to do that in one little town. But I go back to a book that was very well known in the 60s by a woman named Jane Jacobs. And the title of the book was The Death and Life of Great American Cities. And she talked about how the planned development, and especially in the form of subsidized high-rises that became tear-down slums, was that they lacked organic life. You can't just build a couple high-rises, put a patch of grass between them and a couple benches. You really need to create reasons for people to be out there walking from one place to another. So that's really the key to creating a good town center. And to be honest, or to be blunt, I don't see that kind of that thoughtfulness going into a lot of the developments that so far have replaced malls. But in a way, it's kind of like architecture. We don't see a lot of really distinctive architecture anymore. Everybody wants to save money on design and construction. So I've just got my fingers crossed that at least in some places, the developers will say, we're not only going to convert the mall space into something that looks good, but that functions well.
perhaps the primary example of poor design and will people come is in China, where they've built all those large artificial cities that can hold perhaps up to 500,000 people, but they have 400 inhabitants.
And that's where the whole idea of organic life really, it failed spectacularly, because the Chinese central planners of these ghost cities, of which there are a zillion, James Rickards has an amazing, in his book, last book, about amazing stuff about how many of these ghost cities there are, more than you can imagine. And the idea was, well, we're going to put a building here, and that'll be for research and development guys, and we're going to put the manufacturing facilities here, and this and that there. What they neglected to consider was that before you build an R&D office building, you really need the feeder stream there is universities. You need students coming out of engineering and science and math departments, and otherwise those buildings are going to stay empty. So it turns out that capitalism itself is really the best way to organize those things and make sure that they grow in that organic way. The central planners always seem to miss major pieces of it, such as, well, who are the R&D guys who are going to be in these offices?
I also notice designers like to build big, lifeless plazas with no trees and no shade. But what kind of people like to hang out in a place and get baked by the sun?
Well, if it's New York, the plaza will get traversed and seem busy, actually, but you're always going to do a little bit of shade goes a long way no matter where you are, even above the Arctic Circle. Sometimes direct sunlight just makes us uncomfortable, and but too often I guess we see planners who put these designs out that don't have the trees, don't have the shade, and that's why they're lacking in real life.
Do you have to actually let people decide where they want to live instead of trying to direct them to certain places? Because I'm thinking about right now, Canada's upping its immigration rate. Are they going to find affordable homes? Because if they're looking to stay in Vancouver and Toronto, the most popular city for immigrants, we have the highest housing prices. How can these people who probably will work for lower wages actually live?
Well, it creates an excellent competitive opportunity for second-tier towns to say, okay, Vancouver, we know you've got everything and everybody wants to live there, but what happens is you get smaller towns that take quality of life very seriously. And I know, coming from Boulder, that's kind of what's happened there. Silicon Valley got so expensive that when an EE comes in, and he gets hired at $150,000 a year, he thinks that's real money. But, when you go out and price homes in Los Altos, the starters are $3 million, and so that $150K doesn't go very far. So the result has been that little towns have really focused on quality of life things. Boulder is right at the front of that, but it has had more than trickle. You take a place like Pittsburgh, which has always been underrated, and Pittsburgh has had good housing stock forever. They've had great neighborhoods with old brick mansions that you can buy for $2.25, and so what's happened there is that Google saw this, and Google has a major installation in Pittsburgh, partly to take advantage of the fact that Carnegie Mellon was turning out all these robotics geniuses, at which Google came in. They stole every last one of them. But all right, so just the same, a town like Pittsburgh, and even, God willing, a burnout like Schenectady, which once thrived with General Electric executives, and when GE pulled out, there was nothing left in Schenectady except good houses. So the tech trend, I think, probably the most useful part of it, and the one that's revitalizing the country, is literally it's doing it at that level of cities and city planning.
If people have to make that choice between the big city and small towns, does high tech actually allow them to be very productive in small towns because you don't have to drive to work or anything like that?
Well, you just have to come to Boulder to realize how well that works. They've got good bus service for anybody who lives within working distance of the city. The amenities are amazing in terms of hiking, biking, skiing, and all that. And it's no surprise that Google's in there too. Google had 2 big single-floor office spaces, giant buildings across the street from each other. They filled them up, and they basically are building a campus right now that would be for about 2,000 employees, I believe it is. So all these big tech companies are branching out, and when a company like Google or Amazon says they're going to relocate a second major office somewhere, you get a bidding war all across the country. Well, we want you to come here for these reasons, and the net effect is really to get these cities to think, what can we do to make this place attractive? So that to me is maybe the most far-reaching and significant effect of the high-tech business, and that's really, apart from the technology itself and all the products that it's produced.
It's too bad they couldn't put the same kind of incentives out to develop small business, because that's where most jobs come from.
Yeah, and there it's really, I would say, government intrusion that has hurt the small businesses the most. To be an independent restaurant, for instance, it's so difficult. In California, I was just recently in San Francisco, and there had been a wave of restaurant closings that were all directly related to this artificial boost in the minimum wage. If you're paying your waiters and everybody $15 an hour, or moving in that direction, it's impossible to compete. And even the big chains that are supplanting all of the independent operators, whether you're talking about restaurants or hardware stores or whatever, they're struggling themselves. McDonald's being a prime example. Every time the minimum wage goes up X cents, X dollars, it has a very significant impact on McDonald's margins, and they are probably the cleverest company out there as far as what can we do to cut costs.
Rick, thank you so much for being on This Week in Money.
Always a pleasure, Jim. Thank you for inviting me on.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Bob Hoye, and Rick Ackerman, and thank you for listening. Plus, at the end of the show, we'll have company showcase updates with American Manganese CEO Larry Reaugh and Glance Pay President Penny Green. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, President and CEO of American Manganese. Larry, welcome back to the show. And what new things do you have to tell us today?
Well, I got a few new things, Jim, and I'm happy to be on the show. And they may have seen a release yesterday where we've auctioned off our Cobalt property. Well, I shouldn't say just cobalt. It's high-grade copper, nickel, copper, cobalt, and gold, and I mean high grades, to an Australian company, and they're going to be spending a couple of $1 million over 4 years to earn a 60% interest in the project. And I'm really looking forward to that program because they'll be testing things with a new set of eyes that could lead to a significant discovery, because there is some buried riches up there somewhere.
What area are you talking about, Larry?
It's up in New Hazelton, British Columbia. It's just about, it's really close to infrastructure, although it's tough to get to because it's up on the side of a steep mountain, Rocher de Boule. And, but there's power, there's trains, there's a highway that goes right through there. It's within 10 miles of the property. So it's a good spot. and it's had past production, which we've announced, and it actually had a mine up there, working about 8 months out of every year, and that was for actually high-grade copper and lower-grade gold, but the copper ran about 7%. So the Australian company, they've got some ideas on how they want to proceed, and I'm sure that they'll work with our geologist that's done a lot of work up there, and some of our people have done a lot of work up there, make things easier for them. And, I think that we can look forward to some interesting results and drill programs and those types of programs. It's like opening up going over to a slot machine and hitting $10,000. That can happen. Doesn't happen that often, but it can happen. So it's like it's going to be exciting. I mean, we're in the right area. Now we're involved in all the metals and cathode material on a battery for the popular chemistries, and we're involved in a mining property that has the most expensive metal that's involved in it, cobalt. And there's actually things quietly happening in our manganese project. So I think we're going to be a very busy company. This last quarter has been an exciting quarter for the company. As you know, we're expecting to be able to announce that we've filed our patents next week sometime, and that's a major milestone. I'd just like to elaborate on that a bit. The CEO of Cametco has personally written these patents. He's done hundreds, and he's very excited about this project. He's always in touch every day on what's happening, and except for the last week and a half, he's been locked up, making sure he got the patents all done and over to the patent lawyer, and so everything's on time there. And also, we've announced a small private placement that we were taking down to accommodate some of our existing shareholders, and we announced the first tranche of that today. So it's been an interesting end of October and the beginning of November here. Now, there's not much more I can say on that because exciting news is coming next week. So all I can say is that the company and the management has been working diligently on behalf of the shareholders to make sure everything falls into place. And I'd like to just elaborate on the patent process. All that work has to be done, thousands of tests, and there was overtime that had to be accrued on that we had to pay. Because, as you get into it, you find that, hey, this works better over here, so then you gotta switch back and do some more tests and everything like that to bring the patent up. So but it's all been good. And, so we're looking forward to, next week. Looking forward to a good end in this week. And, I think that, the company's made, good progress over the last year, if I have to say so myself. That's kind of a brief message that I have, Jim.
Larry, for new listeners, can you maybe just explain what American Manganese has been up to and why you have such a bright future?
Well, American Manganese has a critical metals company that's had interest in mostly manganese, and with its the property we recently optioned with several metals, and some of them critical. And but we've discovered that our process for treating manganese, low-grade manganese ores, and being able to produce manganese metal and manganese dioxide at prices competitive to China, which has never been done before in the U.S., that process loaned itself to the recycling of batteries, and that's been our major focus for the last year and a half. And we've had great success in that. We've gone from an idea to actually filing the patents in less than a year and a half. And, the shareholders should be happy to see that rapid progress like that, especially when it's all positive. And American Manganese trades on the TSX Venture Exchange under the ticker symbol AMY. It trades in the U.S. under the ticker symbol AMYZF, and it trades in Frankfurt under the ticker symbol 2M. You can find out all the progress that the company's made by visiting our website at AmericanManganeseInc.com, or you can email me at lreaugh, at AMY, symbol for manganese.com, or you can phone me at 778-574-4444.
Larry, thanks for the update.
Yeah, you're welcome, Jim.
I've been speaking with Larry Reaugh, President and CEO of American Manganese. I'm Jim Goddard. We were speaking on November 2nd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with co-founder and president of Glance Technologies, Penny Green. Welcome back to the show, Penny.
Thanks, Jim. It's a pleasure to be here.
Well, it looks like you're into the hottest space on the planet, cryptocurrencies. What can you tell us about it?
Well, it's really exciting. We just announced our main cryptocurrency strategy for Glance Pay this morning, and we're getting very positive response from investors. We have announced that Glance Pay will be launching a rewards-based cryptocurrency through our app. And what that means is that users of the app will be able to use this other cryptocurrency. We may call it Glance Coin, but we haven't got a name for it yet, through the app to buy anything that's offered by any of the merchants that have signed up with Glance Pay. But the really cool thing is now every single time, once we launch our cryptocurrency, every single time somebody uses the app to make a payment, they're going to collect cryptocurrency the same way they would have previously collected, for example, air miles. So it's a rewards-based cryptocurrency. So every time somebody uses the app, they'll receive some cryptocurrency, and they also will have the opportunity to buy the cryptocurrency in case they want to hold on to it, in case they think the value is going to go up.
How is the market reacting to this cryptocurrency announcement?
It's great. I mean, I think generally the public is very excited about anything to do with blockchain and to do with cryptocurrency, because a lot of leaders, industry leaders, are starting to say blockchain is really the biggest and most significant development since the internet. So it's going to change the way we complete financial transactions, the way we complete legal transactions, and it's really quite significant. So sometimes you see these trends accepted by the public first, and in terms of the public that are investing, and we're definitely seeing that. So our stock has gone up today by 8 cents on 3.5 million shares in volume, and we just announced this morning. So that's a pretty positive result.
Penny, what is the market for Bitcoin these days?
Well, as an indication of how quickly cryptocurrencies are growing, the price of Bitcoin has risen over 700% to a market cap in excess of $100 billion US. And the price of Ethereum has risen over 2,500% to a market cap greater than $29 billion in the past 12 months. That's according to CoinMarketCap.com.
Penny, do you feel there's still room for Bitcoin to grow?
Absolutely. The market for Bitcoin and other cryptocurrencies is still in its infancy. According to a recent episode of PBS interview show Charlie Rose, cryptocurrency has officially entered the mainstream. Someone on that show, Kathy Wood, who's the CEO of ARK Investment Magazine, said the network value of Bitcoin, when you include Bitcoin and Bitcoin Cash, is over $100 billion. So it's come up, and it's come up very fast. But it's a fraction of Apple's valuation, of Amazon's valuation, and we think it's a much bigger idea than those. So if you think about it, the global economy is worth tens of trillions of dollars. So there is lots of room for cryptocurrencies to grow.
Penny, does Glance plan to do anything else in the crypto space?
Yes, we do. We've been successful with our financing, and we currently have over $9.4 million in the bank. So we're looking for interesting opportunities to invest in. We're hiring. We're basically doubling our engineering team, and we're looking for developers who have experience building blockchain technology.
Is it easy to find people like that?
No, it's really tough, but we have ads, and we have people that we're interviewing all the time.
Penny, for people not familiar with Glance Pay and what you do and what it does, can you maybe explain how it works?
Certainly. Glance Technologies owns and operates Glance Pay, a streamlined payment system that revolutionizes how smartphone users choose where to dine, order goods and services, make payments, access digital receipts, redeem digital deals, earn rewards, and react with merchants. We're building a valuable network of merchants and consumers, and we offer targeted in-app marketing, geo-targeted digital coupons, social media marketing, and custom rewards programs. The Glance Pay mobile payment system consists of proprietary technology, which includes user apps available for free download in iOS, which is Apple, and Android formats, merchant manager apps, and a large-scale technology hosting environment with sophisticated anti-fraud technology and lightning-fast payment processing.
Isn't the way it works is, for example, if you're in a restaurant, you take a picture of your bill with your phone and it's all looked after?
Yes, we have proprietary technology that we have submitted patents for, which allows people to take a picture of their bill and pay and leave it at restaurants. So it's a very fast and convenient way to pay your bill.
Penny, where is Glance Technologies traded?
We are traded on the CSE, that's the Canadian Securities Exchange, under the symbol GET. We're also traded on the OTCQB under the symbol GLNNF.
And if people wanted more information about Glance Pay?
They can go to one of our websites, either glancepay.com or glance.tech.
Penny, thanks for the update.
Thank you, Jim. It's been a pleasure.
I've been speaking with Penny Green, co-founder and president of Glance Technologies Incorporated. I'm Jim Goddard. We were talking on October 31st.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.